Hey guys, Daniel here with Value Investing with Daniel. Thank you for tuning into this video. In this video, we're going to be discussing a company that I recently invested in, Signet Jewelers. This company I think is very undervalued. I don't believe it's a particularly excellent business, meaning I do believe that it doesn't really have any sustainable long-term competitive advantages. If you look at its return on capital has been eroding for the last 15 years basically, but I still believe it's an okay business and it's selling at an unfairly cheap valuation. To put it in perspective, this company Signet Jewelers, if we see their return on capital has been basically eroded over the last, like I say, 15-20 years. But if we look at the revenue, they have shown a good amount of revenue growth historically, and still continuing roughly into the present last couple of years. This is a company that their free cash flow has been largely positive. Actually, it's been pretty much almost always positive, despite years where and quarters where their net income has been negative. They deliver on average $814 million a year in free cash flow. Now, let's look at it from this perspective. They're a company with basically very little debt, as we can see here. In terms of their long-term debt, they basically got as much cash as debt. They could pay off all their debt immediately, almost, if they wanted to, and then within a quarter, within a quarter or 2 quarters, all their debt could basically be paid off if they really wanted to. So, my concern is not really their debt. I think that they're okay. I think that they don't have really any concerns about their debt. In terms of their business, think of it from this perspective. In a year or 2 or 3 or 4, is there likely to be anything catastrophic that completely destroys their business model? At the end of the year, they're a jewelry store. In business, there's always unforeseen things that can happen, but this is a company with 2,800 jewelry stores all across all across the world, basically. 2,800 jewelry stores with names like People's Jewelers, K Jewelers, Jared, and other famous brand names. That being said, like I say, even though they own these stores, they don't necessarily have a big competitive advantage, as we can see by their eroding return on capital over time. Generally, we want to invest in companies whose returns on capital are increasing over time. But in the case of Signet Jewelers, their valuation is so ridiculously cheap that it hit me over the head how cheap it was. And whenever you have a company that you don't even have to use really any sort of mathematics to determine that it's undervalued, that's really when you know that you have a pretty good bargain. So on $814 million, this company, if we're talking about a free cash flow yield, a fair free cash flow yield on a non-growth company in the current environment would probably be somewhere around 9%. But let's say, because it's a largely retail business, let's say we want a 10%, upfront return on our investment. So on $814 million, if we were to use a 10% cost of capital, which would ultimately be the upfront return we're expecting in our first year as an investor, we could say a fair value on this business would probably be about $8.4 billion, right? 814 million divided by 10% would place a value on this business of about 8.4 billion. And that's being conservative and using a 10%, initial rate of return that we're looking for. Even if we wanted to be very conservative and say we require an 11% upfront rate of return, then that would value the business at about $7.4 billion. So if we were to say in our first year, let's say we were to just buy the entire company, we would say, the company's doing about $814 million a year. Let's assume that there's no growth, even though revenues have been growing pretty much in line with inflation at about 3%, 4%. It's been basically growing along with GDP. Even though we don't expect any substantial growth, let's say we require an 11% upfront rate of return on our investment, and we assume that there's no future growth to be accounted for. We're talking about this company making $814 million, should be worth about $7.4 billion, right? Well, lo and behold, we're saying the company is worth probably about $7.4 billion. If we look at the market cap, it's trading at about $3 billion. So basically, we're saying the company's worth 3.4 and it's only, oh sorry, 7.4 and it's only trading for 3. I mean, that's such a bargain. I didn't even really, I was so shocked and so surprised. Um, it's actually quite an insane bargain. I mean, it basically means it's selling at about 4 times its free cash flow, which for a publicly traded company in an industry that's not really, and a company that's not in distress, in an industry that I can't really foresee it changing dramatically over the next 5 years, is pretty damn impressive. And so for that reason, I put a decent position, a moderate sized position of my portfolio in Signet Jewelers, with the expectation that it would increase the fair value over the next 12 months or so. Now, as you can see, in terms of the company itself, in terms of its stock price, it's quite volatile. I mean, in April 2020, it was as low as $7 a share. So meaning by this point, it's already been a 10 bagger for some people who bought in at the lowest point. But that doesn't mean that it's doesn't mean that it's near fair value now. I don't believe that that's the case. I think fair value for this company is going to be around 7 or 8 billion, maybe 6 billion if you want to be very conservative, maybe 5 billion if you want to be extremely conservative about it. But 3 billion, I mean, in my mind, that's pretty much a steal. You're making all your money back within 3 or 4 years, and all the cash after that is free. And I can't foresee this business model being changed within the next 5 years. And the company basically has no debt. I mean, it's almost a no-brainer. That being said, obviously, with any investment, there's always risks involved. The major risk here is that the market does not recognize how deeply undervalued this particular business is, and doesn't increase the market cap from 3 billion to 6 or 7 billion, or the price from $70 to $140 a share over the next year. Although I believe ultimately that it will. And so that's pretty much my current thesis on Signet Jewelers. I believe that although it's not a great business, it doesn't have a lot of debt, it's in a business that I don't foresee really changing dramatically over the next 5 years. I make all my money back within 3 or 4 years, and all the money after that is completely free. In terms of the number of shares outstanding, this is a business that, if you look sort of over the last 10 years, has been buying back its shares like a cannibal. It's basically been eating itself alive, and buying back its shares since they've been so undervalued historically. But even if we were to assume that, this company just returns, more or less to a fair value, which probably would be about 9 or 10 times earnings. Right now, its forward-looking earnings are at about, it's trading at a forward PE of about 6. So there's quite a lot of room to return to its mean in terms of what it should be selling for in terms of its valuation. So there's a company, like I say, I think it's undervalued by at least 60 or 70%. I bought in a position. Do I think that this is a long-term hold? No, by no stretch of the imagination. I can't see myself holding this company for more than 2 years. But that being said, I do believe that within the next year to 2 years, this is going to double or go up 50%. But keep in mind, that's my personal belief. I could very easily be mistaken. I want you to always remember, as investors, we only have to be right 1/3 of the time. So there's a 66% chance that I'm wrong. And there's a 33% chance that I'm right. That's why I'm not betting my entire portfolio on Signet Jewelers here. I'm taking a moderate position because I believe that there's a good chance, a 33% chance, that it doubles. There's probably another 60% chance that nothing happens, that it just goes sideways over the next 2 years, which is fine. But I'm willing to take the chance that it does double, which I believe there's a fair chance that it does, because of how undervalued it is. So keep that in mind. I think Signet Jewelers overall currently is, from my analysis, is a good investment. I hope you found the video informative. Remember, do your own research, and if you have any questions, please ask in the comment section down below. Thanks.